Morning, dear students. Very good morning. I welcome you to this revisionary session of ICAI on the topic of advanced capital budgeting in the subject of advanced financial management at CA final level. Well, we have actually covered this topic in detail in our regular sessions, maybe around 6 months back, probably. Approximately. I don't remember the exact date, but then it's imperative on our part to ensure that you are in line uh, with the topics as the exams are approaching. So we thought let's just keep certain revisionary sessions for you guys. So the objective of these sessions are going to be to make sure that the concepts are very well revised in this revisionary session, and also some of the questions we will be discussing, some of the questions which will be uh, helpful for us to revise the concepts are also going to be solved in this class. We'll attempt, we'll have a modest attempt today rather to complete this topic of advanced capital budgeting in today's session. So I'll be like quickly running through the concepts and then taking up certain questions to tackle the concepts in a better way. We'll do it in this way, a concept, quick revision of the concept, and then we will straight away go for the question based on that concept. Again, another concept, and then we'll go for the questions. Okay. So in this span of 3 hours, we'll try to make sure that the things are covered in a very well defined manner. Okay. Now, let's.
Sir, just a second. Students, you are kindly requested that if you have any query pertaining to your previous session, you can also ask from Jagbandhu sir in this session as well. Okay.
Yeah.
So because this is the purpose of this session is that if any query is pertaining to your previous session, well, a recorded session, because I hope you have gone through this session as well. Okay, sir, please continue.
Okay. So let's take up the concepts and then followed by the questions based on those concepts. So let's just get started. So the first thing that we are going to discuss about in this advanced capital budgeting is the impact of inflation on capital budget. So impact of inflation on capital budgeting. Now, we all know that in this topic of capital budgeting, the cash flows that we are going to consider, they may be real cash flows or they may be nominal cash flow. Okay. So if you have like real cash flows, they will be discounted at a real rate of return. Okay. And if we have the nominal cash flows given in the question, then we are going to discount the nominal cash flows at nominal rate of return. Now the question arises, what's the difference between nominal cash flows and real cash? Well, real cash flows, when we're talking of the real cash flows, what are they? Real cash flows are the cash flows at current price levels. Or you can say or I can say that real cash flows are the cash flows at current price levels. That is, cash flows assuming there is no inflation. When you keep the prices constant, when you are keeping the cash flow price levels, cash flows constant, then you can say that real cash flows are the cash flows at current price level. That is, cash flows assuming that there's no inflation ongoing in the market. Okay. Then you have the nominal cash flows. So nominal cash flows are basically cash flows adjusted for inflated price levels. So magnitude wise, number wise, obviously the nominal cash flows are going to be larger than the real cash flows because nominal cash flows include the impact of the inflation, right? And it's quite obvious that when you say real rate of return is definitely going to be lower than the nominal rate of return. So the real rate of return and nominal rate of return needs to be defined. So understand that when you are asking for a rate of return without inflation, so assuming that there's no inflation in the market, there's no inflation in the uh, in the economic system, then you say what's the rate of return that you need? Because at that time, when there's no inflation, for what sake are you going to ask for some rate of return? Definitely, you're going to ask the rate of return for the sake of risk that you are undertaking, right? So you're going to ask for the risk that you're going to undertake, right? But when there is inflation in the market, you will definitely need a higher rate of return. So we have already covered that there's a relation between the real rate of return and the nominal rate of return. So we are very well aware that we compute that 1 plus real rate multiplied by 1 plus inflation will be equal to 1 plus nominal rate. 1 plus real rate into 1 plus inflation is equal to 1 plus nominal rate. Okay. So 1 plus real rate multiplied by 1 plus inflation rate will give you the nominal rate. So for example, if I tell you that nominal rate of return is 12% and inflation is, let's say, 6% or inflation is, let's say, 5%. So can you tell me what's the real rate of return? Can you tell me what's the real rate of return, guys? Yep. Can you compute and tell me what's the real rate of return? Yeah, guys. So it will be 1 plus
1.0667.
1.066. Okay. So that's typically going to be like in our question, it's going to be 1.12 multiplied. It will be 1 plus real rate multiplied by 1 plus inflation is 1.05 is equal to 1.12, right? So if we just solve this, we can get this as 1 plus real rate equal to 1.12 divided by 1.05. It's 1.0667. So real rate of return would be 6.67%. Okay, so that's how we get the real rate of return from a nominal rate, right? One more concept that we had in this inflation adjustment was, if you could remember, that inflation adjustment should be done at all different cash flows, definitely. But there is one component when we are computing the cash flow after tax where you will not get any inflation adjustment effect. What was that component of the cash flow after tax? Can you recall? What was the component of the cash flow after tax?
Depreciation.
Exactly. Very good. Depreciation. Because see, basically depreciation is not the cash flow, but the tax saving on depreciation. You know that tax saving on depreciation is definitely not something that's going to be getting impacted by the inflation. Right? Yes, because whatever is the amount of depreciation, you're going to claim it as it is, right? So, I mean, the cost of the asset is not going to be adjusted for it, right? So, cost of asset is not going to be definitely adjusted. So, the tax saving on depreciation, that component of cash flow, we know it should not be adjusted for the inflation because it's going to be the same number. It's not going to be something which will increase due to inflation effect. Okay, so just we'll keep that in mind. I think we are good enough to revise. I mean, this is done. So let's just get started with the questions. Okay, so that we are in a much favorable position to understand it better. So I think this assignment is already uploaded on the portal. So we'll be doing this question number one next. Let me take up this question number one for discussion. Here we have this question. Yeah. So Shashi Company Limited has projected um, the following cash flows from a project under evaluation. So we have like year 0, 1, 2, 3, 3 years cash flows are given to us. Uh, so it's like initial investment would be 72, followed by cash inflow years 1, 2, 3 of amount 30, 40, and 30. The above cash flows have been made at expected prices after recognizing the inflation. So these cash flows are made at expected prices after recognizing for inflation. So can you tell me what are these cash flows? Are these real cash flows or are these nominal cash flows? What are these cash flows?
Nominal.
Nominal. Right? So it's a nominal cash flows because they're saying that prices are determined after recognizing the inflation. Okay. The firm's cost of capital is 10%. The expected annual rate of inflation is 15%. Okay. So the firm's cash flows are, I mean, the cost of capital is 10%, inflation is 5%. So how the viability of the project is to be evaluated, present value factors are given to us as from year 1 to 3 as 0.909, 0.826, and 0.751. Okay. So the firm's cost of capital is 10%, whereas the inflation rate is 5%. So cost of capital is basically giving effect of the risk that the entity is undertaking. So we can definitely solve it uh, in a way that since these are the nominal cash flows, what rate of discounting will I need? Since these are nominal cash flows, what rate of discounting am I going to need? Real rate of return or nominal rate of return? Nominal rate. We need to get the nominal rate of return. So we have the real rate, this 10% is since it's a cost of capital. So that's the real rate. Plus, we also need to tackle for the inflation. So I need to get the nominal rate of return. So one way is to convert these, discount these cash flows using a nominal rate of return. Other way you can say is, let's just try to convert these nominal cash flows into real cash flows. By the way, how do we convert these real cash flows to nominal cash flows to real cash flows? Simply by discounting them for the inflation adjustment, and then discount it again with the real rate of. Now let's just do it with the first method, which we said. Let's compute the nominal rate of return. So we know the formula: 1 plus the real rate multiplied by 1 plus the inflation. It should give us 1 plus the nominal rate. Okay, so 1 plus real rate is what we have as 1.1 multiplied by 1 plus inflation, that's 1.05, and that's equal to 1 plus the nominal rate. So we say that the nominal rate of return nominal rate of return is 1.1 multiplied by 1.05 minus 1. We get this as 15.50%. Correct? Did you get this nominal rate, guys? Yeah. Okay. So now, once we have got the nominal rate, now we just need to discount these cash flows at 15.5%. Let's just write down this as here. We have particulars and cash flows, PV factor, and then PV. So here 0, we have the initial investment being that. Cash flow is minus 72. And then we have here 1, 2, 3, which is maybe this is our cash flow after tax. Right? And then cash flows would be like 30, 40, and 30. So present value factor, we definitely need the present value factor at 15.5%. Okay, so present value factor at 15.5%. Can you just get these present value factors multiplied with the PV factors and provide me with the NPV number? Yeah, guys. Get the PV factors at 15.5% and give me the PV number. Calculate it quickly, guys. I'll just give you maybe a couple of minutes for you.
So PV factors 0.866.
0.866. You're talking of PV factor?
Yes.
1 divided by 1.155. Okay. This will be 0.866. So let me just take it as 3 decimals. Then we have it for 0.750. And finally, we have
PV 25.98.
okay. This
30.
And then we just multiply it.
90.
Bit of rounding up may be possible. So just ignore that part. So in PV, is it
75,428.
5.45.
5.45?
3.42.
Sorry,
3.43.
Yeah.
3.43, 42, 45, somewhere around 3.4 it should be there. Okay, so rounding up errors are accepted. That's fine. 3.43 is the answer for the NPV. Is this perfectly fine, everyone?
Yes, sir.
Yeah. Okay, let's discuss about the second approach also. What was the second approach I said? I said, let's just convert these nominal cash flows to real cash flows first. And then we will, take the PV using the real rate of return. Right? So let's just try to do it here. Particulars. It is. Yep. These cash flows are nominal cash flows. Right? So these cash flows are basically nominal cash flows. These nominal cash flows needs to be converted to real cash flows. How do I convert them to real cash flow? Because I need to discount it by 5% every year. So we'll talk of real cash flows. Well, real cash flows is going to be computed as nominal cash flows divided by 1.05 raised to number of years. Pretty simple about that. So we can say nominal cash flow, since this is the first year, 0th year, it's going to be remaining same, but this 30 needs to be discounted by 5%.
28.57.
So 30 divided by 1.05 because it's going to be adjusted for inflation. So for after discounting it for 1 year, you can say it's 28.57. Then subsequent it's 36.28 and then 25.92. That's the real cash flows. If we get these real cash flows, just verify, guys.
Yes, sir.
We're just discounting the nominal cash flows with the inflation rate. And then we'll take the present value factor at the rate of 10%.
Given है question.
So in that PV factor is given to us 0. This is going to be 1, 0.909, 0.826, and 0.751. And then we can simply take the present value. So present value is going to be nominal cash flows multiplied by PV factor. I did some mistake. It should be real cash flow multiplied by the PV factor at real rate of return.
Yes,
And that gives us like 3.40, approximately same, but some rounding of error is definitely accepted because anyways, we have just taken this 10% as, the PV factors are taken up to 3 decimals. Okay, so I hope both these things are clear to us, everyone. Inflation adjustment thing is clear to you, everyone. Well, good. Okay, so then let's just go for next aspect, which is understanding the risk that is involved in a particular project. So to understand the risk involvement in the project, we calculate certain statistical tools. We use certain statistical tools like the standard deviation and coefficient of variance and all. So let's just try to get into that understanding of measurement of standard deviation, expected value, and so on and so forth. So let's just do one thing. I'll do this I'll explain you with this help of question number 2. I'll do this project K for you, and then project S is something that you are going to try it on your own. Let's just look at the question. So KLM Limited is considering to take up one of the 2 projects, project K and project S. Both projects having the same life, require equal investment of 80 lakhs each. Both are estimated to have almost the same yield as the company is new to this type of business. Cash flow arising from the projects cannot be estimated with certainty. So as the company is new to this type of business, the cash flow arising from the projects cannot be estimated with certainty. An attempt was therefore made to use probability to analyze the cash flow from other projects during the first year of operations. This pattern is likely to continue during the life of this project. The result of the analysis are as follows. Project K and project S, we have cash flows given, we have given the probability. We have to compute variance, standard deviation, coefficient of variance for both these projects. And we have to say which of the 2 projects is riskier. Okay, so we'll do project K together. Project K will calculate the variance, standard deviation, coefficient of variance for project K. And for project S, you will be doing it on your own. Okay. Now, let's go for this project K. So in this project K, we have like given to us probability, as P. And we have the cash flows. Next project P, and then the cash flows. Let's write it down. So it's like 0.1, 0.2. Point 4, 0.2, and 0.1. Cash flows are 11, 13, 15, 17, and 19. We have this cash flow. We have to compute the standard deviation, variance, and coefficient of variance. So first up, we need to compute the expected cash flow. How do we get the expected cash flow from the project? Can anyone tell me? How do you get the expected cash flow?
CF multiplied by probability and total
Perfect. So
return.
it's going to be probability multiplied by
Cash flow.
cash flow. Probability multiplied by cash flow. So let's just multiply this cash flow and just give me the total, guys. Give me the total. Solve it. And give me the total.
15.
How much is it?
15.
15.
1.1.
Yes. That's 15. Expected cash flow. We're getting it as 15. Expected cash flow is nothing but summation of, is simply summation of probability into cash flow. Summation of probability into cash flow, we get this answer as 15. Now, next is we want to compute the variance and standard deviation. So variance and standard deviation, for that, we need to do cash flow minus the expected cash flow. Cash flow minus expected cash flow. And then we need to take the square of this. Cash flow minus expected cash flow square. Cash flow minus expected cash flow square. Cash flow minus expected cash flow. And then we take the square of it. So just do it and give me the total of, not total of this. We need to further multiply this with the probability also. So probability multiplied by cash flow minus expected cash flow square. Get this number. Cash flow minus expected cash flow. So take the difference, multiply the square of this difference with the probability, and give me the total. Give me this total. That will give us the value of variance. Variance of
60
cash flow.
total.
Did we get it? 11 minus 15. And this is probability multiplied by this.
4.8.
So the total of it is 4.8.
Yes, sir.
Now, how do we get the variance of cash flow? Variance of cash flow is simply summation of probability into cash flow minus expected cash flow square. That's obviously the summation of this is simply 4.8. That's 4.8. Variance of cash flows is 4.8. Now, how do we get the standard deviation of cash flows from this?
Square root of variance.
Perfect. It's going to be square root of variance. Right? So that's going to be square root of 4.8. Is square root of 4.8.
2.19.
0.19.
Yes, sir.
That's the standard deviation. So we got expected cash flow, we got variance, we got the standard deviation of cash flows. One more thing that we need to compute over here is coefficient of variance. Now, coefficient of variance is simply standard deviation upon
expected cash flows.
Expected cash flow. If you multiply it by 100, obviously you can say percentage terms. So you can say that standard deviation upon
15.
variance, 0.19 divided by 4.8, which is 45.64%. Or to understand it in a way, we can say that the expected value, which we got it as 15, it is subject to a fluctuation of 45.64%. It can fluctuate 45.64% upside or downside.
Sir?
My bad. Should be 15, correct. 14.61%. So this 15 is the expected value, but in that you can expect a deviation, you can expect a variation of 2.19. And so it can fluctuate 14.61% upside or 14.61% downside.
One student is asking something. Just I think one student has raised something. He has started speaking, then he stopped. Is it?
I have addressed that, so don't worry.
Okay, then continue, please.
Okay. Coefficient of variance is 14.61%, which simply indicates that your expected value can go up by one standard deviation up or one standard deviation down, which is 14.61%. It can fluctuate. Now, so that's project K for us. Can we solve on the similar lines for project S also, guys? Can we solve it on similar lines for project S? Right? And do it, guys. Pretty easy. Let me just put down the numbers. Project X is 0.1, 0.25. Then we have 0.30, 0.25, and 0.1. Okay. That's the probability. Cash flows are 9, 13, 17, 21, and 25. Okay, so I'll just give you, again, in total, can give you like 3 minutes to solve this quickly on the same lines as K. And then based on that, we will be in a position to tell which of these projects is more riskier and which is less riskier as compared to the other part. For me, it is just easy because I just need to paste it over here, but I want you to solve it. Solve it and give me the expected value first, guys. Then followed by the variance, followed by standard deviation and coefficient of variance.
17. Expected value is 17.
Expected value is 17. Okay.
Variance is 20.8.
Variance is
20.8.
20.8. Variance is 20.8. Check for these numbers.
Standard deviation is 4.56.
Okay. So we have expected cash flows to be 17. Variance is 20.8. Standard deviation is square root of this 20.8. Then coefficient of variance.
$26.8.
The standard deviation upon 70 is 26.83%. Yes, did you get it? Are you getting all these numbers? I think Abrakesh ji, you have got it wrong. There's some mistake that you have done.
Yes, sir. Actually, I
Yeah.
missed one stage, so that's why my answer was.
Okay. Coefficient of variance is 26.83. Now, looking at these two numbers, coefficient of variance, can you tell me which of the projects is more riskier?
S is riskier.
Project S is riskier, right? Because the variance is high, and of course, the standard deviation is also higher, and obviously, the risk with regards to the return also, expected cash flow, the risk with regards to the expected cash flow, that's also significantly higher. So, we can say project S is a riskier proposition. Okay.
Sir,
Yeah.
hello. I have one doubt in terms of risk risk factor, which is
Mhm.
the most which is the most preferable, SD or coefficient of variance in terms of risk.
In terms of risk, it's going to be coefficient of variance. Okay. So, I mean, because of standardized part that is being undertaken. Because see, the numbers returns may be different for two different projects, and the cash flows may be different. Returns may be bit different because the numbers can be different. Here the numbers are smaller, and here you can see there are bit of larger numbers available over here. Right. So whenever we talk of comparison point of view, it's always going to be the coefficient of variation or coefficient of variance. Okay. So when you want to compare projects, it's going to be the coefficient of variance, and that's a better way to deal with the risk, right? Because here you can see the expected cash flow is higher in project S. So we would obviously expect the standard deviation is higher over there, but in order to know whether that higher cash flow is sufficient to cover the standard deviation, yes or no, for that we need to look at coefficient of variance. So for comparative purpose, it's always going to be coefficient of variation that needs to be referred.
So, sir, higher coefficient of variance is higher risky
Yeah,
proposition.
if the coefficient of variance is higher, it means the risk is higher over there. Okay, are we good, everyone?
Yeah, clear, sir.
Okay, perfect. Then, yeah, we're looking at the next way of dealing with the risk of a project, that is by undertaking something called as sensitivity analysis. Can anyone just tell me what do we really do in this sensitivity analysis?
At which present value of cash flows is equal to present value of initial investment.
Present value of
Initial investment means cost only.
hmm,
It is the effect of change in certain respective variables on the NPV.
mhm. So sensitivity analysis we can actually look at in a two different perspective. Obviously, the result for both of them and the conclusion is going to be same. One way is to look at it like if there is certain percentage, let's say for example 10% change in one of the variable, what is the resultant impact on the NPV? Right. So the variable which is having the highest impact is said to be the most sensitive. Right. And the other way to look at it is what percentage change in one of the factors, one of the variables, is going to make my NPV zero, right? So there, whichever factor is going to make the NPV zero in a very small fractional change, we are saying that it is going to be most sensitive one. Okay, so let's try to uh, get the hand of it with this question number 3, sensitivity analysis. So Red Limited is considering a project with the following cash flows. Let's say the cost of plant is 10,000. They've given us the running cost and also the savings for 2 years. So 12,000 and 4,000. The net cash flow, we can say it's going to be like 8,000 and 9,000. Now the cost of capital is 9%. You have to measure the sensitivity of the project to changes in levels of plant value, running costs and savings, considering each factor at a time, such that NPV becomes zero. So you want to make the NPV zero, right? The PV factor is at 9% as given below. Which factor, except time period, is most sensitive to affect the acceptability of project if they vary adversely by 10%. These are like we are going to solve it in dual way. We are going to do it in two different ways. One is by changing one of the variables. I mean, changing all these variables, let's say by 10%. And secondly, we'll also try to look at how much change in the variable is going to lead to a change in the NPV to zero. Okay, so we have here and the cash. Right? Then we'll write down the PV factors and then PV. But before that, let's just write down the variables over there. What are the variables? The variables that we have is, one is initial investment. So initial investment at current level is 10,000. Then we have another variable as savings, which is every year 12,000, 12 and 14,000. Okay. Followed by costs. Costs are 5,000 and 4,000 and 5,000. So there are two different numbers for 2 years. And we have cost of capital given as 9%. And number of years, 2. Number of years is going to be 2. So original, let's try to first get the original NPV. Okay. So in 0th year, there's going to be a cash outflow of 10,000. In first year, we will say that savings and costs are going to net off each other. The 8,000 in the first year, which is 12,000 and 4,000. And then it's going to be 14,000 minus 5,000, 9,000. We have PV factor at the rate of 9%. Yes, Abrakeshji, you're saying something?
Sir, my question is regarding a real and nominal percentage.
But I don't think this is relevant over here, right?
No, that's why I mean, when should I ask? Okay, I agree.
Okay, you can ask it now. So,
Okay, thank you.
okay, so present value factor at 9%, 1 divided by 1.09 is the number of years, which is 0. That's going to be 1. Then you get these PV factors. Take the PV as cash flow multiplied by the PV factor, and then take the sum of
4,930.
4914.
4914.
14.
4914.57. Okay.
Yes, sir.
4914.57. That's the NPV as of now. Now let us change one of the variables and by 10%, and let's see what is the impact on the NPV. Right. So first we will say initial investment increase by 10%. When the initial investment is going to increase by 10%, when the initial investment is going to increase by 10%, of course, the NPV is going to fall. Initial investment, if it
3,000.
increases by 10%, NPV is going to fall. So when initial investment is going to increase by 10%, NPV is going to fall. For us, what is important is we need to know by what percentage is it falling. So can you just walk around with this same table? The only change being the initial investment is not going to be 10,000, but rather it's going to be 11,000. Right? Rest all remaining same.
3,940.
Right? Rest all remaining the same. So that should give us this value as 3914. So can you tell me what is the percentage change in NPV? How much is the change in the NPV? Well, the NPV was 4914.57 earlier, and the new NPV is 3914.57. You can say 3914.57 minus 4914.57 divided by
20.35%.
4914.57. The percentage change is
20.35%.
20.35%.
35%.
20.35%, right? So what is the sensitivity then over here? The sensitivity of initial investment. Sensitivity of initial investment, we can say that NPV is changing by 20.35% for a 10% change in sensitivity of initial investment. We can say it changes by 20.35%. NPV changes by 20.35% for a 10% change in the change in the initial investment. So you can say it is 2.03 times. 2.03 times is the sensitivity. So we can say if there's a 1% change in the initial investment, NPV is going to change by 2.03%. If there's a 1% change in investment, 1.1% change in the initial investment, the NPV is going to change by 2.03%. Okay, so that is one factor. Let's just change the next factor. Next factor is, let's say, savings. Now, what will happen with? Yeah.
Why ain't we take negative 20.35% as a sensitivity of initial investment?
Sorry, can you repeat?
Why we not taken negative 20.35% as
Sensitivity is just a positive number, so you need not take it in a negative sense, because certain variables decrease in value will lead to fall in NPV, and certain variables increase in value will lead to fall in NPV. But our idea is what is the net impact on that? Like, we already know that investment, if the initial investment increases, NPV is going to fall, right? So 2.03, it's just an absolute number, and we are going to compare this number throughout. Like, we are going to compare this sensitivity number for all variables. It's not going to be that someone is negative, someone is positive, so negative is a better thing and positive is a bad thing. It's nothing like that. So it's just an absolute number, sensitivity, looking at what is the percentage change. Because whichever variable is having this number as the highest, we can say that variable is the most sensitive one. Okay. Now, what should happen to the savings so that there is a fall in NPV? What should happen to the savings so that there is a fall in NPV? Savings should increase or decrease? Savings should decrease, right? Savings, let's say, decrease by 10%. If your savings are going to decrease by 10%, zeroth year cash flow will be same, 10,000. So what about the first and second year cash flow? How much is going to be the first and second year cash flow? How much is the first and second year cash flow?
6,800.
Your savings is going to decrease. So instead of 12,000, it will be 12,000 less 10%. Right? It's going to be 12,000. You can say into 90% minus the cost is still 4,000. 1,800. And this is going to be like 14,000.
7,600.
90%, 7,600. Just get the NPV and give me directly this number. Sensitivity of savings. Give me the sensitivity numbers for the number for the savings.
$4.64 times.
4 point. Okay. So cash flow multiplied by PV factor. Sum of it.
46.4%.
Percentage change in NPV. It is 2635.30 minus original NPV was 4914.57.
Yes.
Right? And this we can say 46.38%. So sensitivity is going to be 46.38 divided by
10%.
10%,
4.64%.
is 4.64%. So can I say savings is something more sensitive? Savings is more sensitive than the initial investment because the NPV is going to be getting impacted by 4.64 times. NPV is going to be impacted by 4.64 times, right? So we can say savings is having a bit of higher sensitivity as compared to initial investment. Now, next variable that we're going to look at is the cost. What should we do with the cost so that there is so that we compute the sensitivity of NPV? Increase. The cost increase by 10%. Just try to calculate this entire part, guys. If the cost increases by 10%, then what is the impact on the NPV? Try to calculate it.
1.60 times.
1.60 times. Okay. Right. Let's take this original number. Cost is going to increase by 10%. So into it 12,000 minus 4,000 into 1.1.
Yes.
And this is going to be 14,000 minus 5,000 into 1.1. PV factor at 9% is taken, and then we have this 4126. Percentage change in NPV will be 4126.76 minus 3914 minus it is 4914.57 divided by 4914.9 is divided by 4914, 16.03%. And we have the sensitivity of cost.
1.60 times.
Sensitivity of costs as 16.03 upon 10%. That's 1.0 times. So out of these three variables, which one is the most sensitive one?
Savings.
Savings is the most sensitive one. So what sort of action are you going to take once you've identified that savings is the most sensitive one?
We will discount it by higher percentage.
Sorry? We're going to place more control over the savings because we are pretty sure that a small change in savings will lead to have a great impact on our NPV. So we need to keep a watch on the movements that are happening in the savings in the project. Say savings or revenue or whatever it is. Okay.
सर आपका स्लाइड थोड़ा सा नीचे करना.
Slide. You want the full screen of view of it?
Yeah. Yes.
Okay. Just wait. I'll just adjust it. Is it perfect now?
सर
Yeah.
हमने जो 10% लिया है वो assumption है ना, कोई भी person ले सकते हैं ना?
That's given in the question, beta.
Okay, sir.
That's given in the question, sir. If the project is vary adversely by 10%.
Okay, sir.
Okay. So in this way, we can do sensitivity analysis by understanding which one of the variables are going to have a greater impact. Now, another way of looking at this particular sensitivity analysis is to check what percentage change in the variable will lead to NPV becoming zero. Right? So what percentage change in the variables is going to cause it's going to cause the NPV to become zero. Now, how do I really understand it? Like if I question you that what percentage change in initial investment will cause NPV equal to zero? Can anyone answer this? How much percentage change in NPV is going to make the how much percentage change in the initial investment is going to make NPV as zero?
49.15.
49.15. How did you get it, Abhikesh? How did you get it? 49.15. Yep. How did you get it? I think Prithviraj has also asked. Original cash flows, all other cash flows are going to remain same. Of course. All other variables are remaining same. We are just changing the initial investment.
Yes, sir. So our outflow should be 4914.57 in first case.
Perfect. So since our NPV is 4914.57,
Yeah.
we want to make this NPV as 0. So
Okay. So it
basically,
will be sorry, 51 point. So our 4914.57. So our outflow should be 5085.43.
outflow should be
4
5085.
5085.43.
Mhm. Now, just we can simply answer it in this basic. We want the NPV to be 0. Our original NPV is 4914.57, right? Our original NPV is 4914.57. We want to make the NPV as 0, right? So just need to look at, like, to make NPV as 0, we need to make NPV as 0. We need to increase, make NPV as 0. We need to increase investment by 4914.57. Because if your investment increases by 4914.57, then the NPV is going to it's going to become 0. So what is the percentage change in investment? That's going to be 4914.57 on 10,000. So we can say, if you are going to increase your initial investment by 49.15%, or change in initial investment, if it is 49, if it's going to increase by 49.15%, that will make my NPV as 0, right? So 49.15% change in the initial investment is going to make the NPV as 0, right? Then another variable that we're looking at is now savings. So let us say we're looking for what percentage change in savings will cause NPV equal to 0. Can we compute this? What percentage change in savings is going to cause NPV as 0? Can anyone attempt this to know that how much should the savings be changed? What percentage the savings should be changed so that NPV is going to become 0? Yep. How much percentage change in savings is going to cause the NPV to be 0? Can you think of how are we going to work it out?
We will increase the savings.
Yeah, we'll definitely increase or decrease?
Decrease.
Decrease.
Sorry, decrease.
We will decrease the savings. But my question is, what should be that percentage by which I should decrease the savings so that the NPV is going to become 0?
21.56.
21.56. How did you get it?
Original NPV is 4914.
Okay.
And savings, discounted savings is 11,004 and 11,788.
6,000 savings. 6,000 savings? Where did you get the 6,000 savings?
Not 6,000, sir. 22,792.
22,792. Where did you get this? Are you taking PV of
Yeah, discounted savings in the multiplied by
discounted
the present value.
savings? But we want to know how much should be the percentage change in savings
21.
amount.
21.
21. So you mean to say that if I'm going to change the savings by 21%, the NPV should become 0.
Yes, sir.
Okay, let me just try to put it. Let me take a cue from here. Sensitivity of savings was 4.67, right? Sensitivity of savings was 4.64 times. What does this imply? This implies that 1% change in savings leads to 4.64% change in NP, right? Now, it is quite obvious that if the savings are falling, NPV is going to fall, right? So, we are not looking at that sign per se. Okay, so 1% change in savings lead to 4.64% change in NPV. Now, when we want to make the NPV as 0, can you tell me what percentage change are we looking at? What percentage change in NPV are we looking at?
49.1.
No. What percentage change in NPV are we looking at? If you want to make the NPV as 0, how much percentage change in NPV are we looking at? 100%. Am I right? Currently, your NPV is 4914.57 and you want to decrease it by 4914.57. So, you are looking for a, what should be the change in savings so that there is 100% change in NPV. We are essentially talking of X percentage change in savings leads to 100% change in NPV. Can you tell me what is this X percentage? How much is this X percentage going to be? Doing the cross multiplication?
46.4.
100 divided by 4.64, right? So this is 100% divided by 4.64, which is 21.55%. Just test this. We got this X percent as 21.55%. It means if we are going to change the savings, if we are going to reduce the savings by 21.55%, are we getting the NPV to be 0? Just check it, guys. You can just easily check this. Just copy it and let me just check whether this is working or not. So this is going to be like cash flows, but let me just look at this cash flows as originally cash flow was 12,000. So from that 12,000, we are going to reduce this 21.55%. And here again, it's going to be 14,000 into 1 minus this. And of course, I need to subtract the cost also, 4,000. And here also the cost will be subtracted, 5,000. Can you observe it's coming out to be 2.35? Now that 2.35 is anyways acceptable error because, that's like approximately 0. It's going to be approximately 0 because rounding up error. Because we anyways have the PV factor influence and also we haven't taken all the decimals over here. Are you able to get it? The method? We take a cue from savings decrease. We say that it's 4.64%, 4.64 times. So we say that if the savings are going to reduce by 21.55%, the NPV will become 0. So the limit by which the savings will be allowed to change is 21.55. The moment the change is more than 21.55%, can you tell me what's going to happen? If there is a change in the savings by more than 21.55%, what's going to be the impact on NPV?
Negative
It will become
NPV.
negative, right? So if I just compare like initial investment and savings as a two variables, which of these two variables are more sensitive? Of course, this is more sensitive. I mean, the savings is more sensitive because to make NPV 0, you just need to trigger the savings by 21.55%. But if you want to make NPV 0, you need to trigger your initial investment by 49% to make it 0. right? I hope we are connecting what I'm talking of. Are we connecting what we are talking of, everyone? Are you able to connect with me?
Yes, sir.
Yeah. Okay.
Yes.
So out of these two, of course, the savings is more sensitive because a small change in small percentage change in savings is going to lead to a large change in the NPV. Can you same way compute what percentage change in costs
Yes.
will cause NPV 0? Can you please work this out, guys? Can you please work this out?
Six 6.23. 100 divided by 16.03.
16? No. Sensitivity is 1.6 over here.
62.5.
Just repeat it over here for you. There you go. Sensitivity of costs 1.60. So 1% change in savings will lead to
1.6.
1.6% change in NPV. So X% change in costs leads to 100% change. So this is going to be like 100% divided by 1.6, that's 62.38%. And then when we look at the numbers here, savings remains the same, but costs are going to increase by this percentage, 62.38. Then this is also going to be like 15,000 minus 5,000 into 1 plus 62.38. See, we are getting this as 0 over here. Right? 62.38. Again, the conclusion remains the same. You see that the cost needs to be changed drastically by 62.28% to make your NPV 0. Right? So to make your NPV 0, this percentage is basically required, which is a drastic change is required. So this is going to be the least sensitive one. And highest sensitivity is in the savings. Right? So like we can simply, this verification part is not required. You just need to look at the sensitivity and then see what is the change that is happening. Okay. Now here I have to use this particular method because the savings and costs are different for 2 different years. But in case of initial investment, I didn't do this, X percentage and all such. I just said that I need to increase the this by something. So you can simply change the initial investment of this amount and you get the percentage change. Yeah. So you can directly compute for some variables. For some variables, you cannot compute it directly because you need to know the impact of the change in the 2 variables. In the respective years also. So it's better to go for, compute this original thing and then just use the X method to get the percentage change required. Okay. Very good, everyone.
Yes, sir.
Yes, sir.
Okay. Fine. So I think, yeah, that's complete. Yeah, question number 3 is done. Then let's look at this question number 4 now. A company is considering project X and Y with the following information. We have got the expected NPV, we have got the standard deviation. Which project will you recommend based on above data? Explain whether your opinion will change if you use coefficient of variation as a measure of risk. Which measure is more appropriate in this situation and why? So we have two projects X and Y. Expected NPV is 1,22,000 and 2,25,000. Standard deviation of 90 and 120. Now in this case, if you're just looking at only expected NPV, because if you're not regarding the standard deviation at all, if you're looking at expected NPV, which project are you going to choose?
Why?
Which project? Why? But here, when we just put our eyes on the standard deviation, we find that project Y is definitely providing me a higher expected NPV, but it comes at a cost of higher standard deviation. It comes at a cost of higher standard deviation. So, what are we really going to look at or work around it? So, which project is going to be recommended based on the above data?
X.
We will compute the coefficient of variation of X and coefficient of variation of Y. So, how much is the coefficient of variation of X? This is standard deviation, which is 90,000 upon 1,22,000. What is this number?
1,20,000. It's a 1,22,000.
22,000. Yeah, sorry.
So 0.7377.
Or if I write it in percentage, that's 73.77%.
73.77%.
Okay.
Yes.
What's the coefficient of variation of Y? 1,20,000 divided by 2,25,000.
It's 0.53%.
53% we can say.
Yeah, sir.
So out of these two, which of the projects will be chosen? Out of project coefficient, I mean, which of the projects will be chosen? Of course, project
Why?
Y will be chosen because
Y.
it has a lower coefficient of variation, right, as compared to the X component, X part. Right. So whenever we are looking at this, we need to measure the coefficient of variation using these. I mean, the project should be chosen on the basis of these two things. Okay.
Sir, what should be our answer in the last line? Which measure is more appropriate in
Coefficient of variation. Coefficient of variation should be measured because here expected NPV is higher for a cost of standard deviation. So I need to standardize both of them. Like I'll put a case in front of you. Had it been like X and Y, and we have the NPV number and standard deviation number. So let's say X is having 1,20,000 as NPV, and this is 1,50,000 as NPV, and this is standard deviation is, let's say, 50,000 and 50,000. Which one will you choose? Which project is going to be chosen?
Why?
Why? Because
NPV is
why
higher.
are you going to choose Y?
NPV is higher and standard deviation is same.
Both the projects, the risk is same, right? But NPV is different. So higher NPV will be the one that will be preferring, right? But now, if we have like something like this, is 1,20,000. Also 1,20,000. And standard deviation is 50,000 and 60,000. Now tell me which one are we going to choose?
X.
X. Why are we going to choose with X? Because the expected value is same, but the standard deviation is lower. So when the expected value is same, but the standard deviation is lower, we are definitely going to choose with a lower standard deviation, right? But if we have a situation like in this question where we have like for one of the projects, standard deviation is lower and even the expected NPV is lower, then we cannot decide which one to choose. So there we have to obviously go for coefficient of variation. Okay, the coefficient of variation will not be referred if either of the two things, that is NPV or standard deviation, are same. If NPV or standard deviation are one and the same, then we will obviously look at, like, if your NPV is same, you will look at the lower standard deviation first. If the standard deviation is same, then you will look at the higher NPV project. And if both of them are definitely different, then you need to compute the coefficient of variation.
Okay.
Clear, everyone?
Yes, sir. Thank you.
Okay. Fine. That's question number 4 for you. Now, let me just do something called as certainty equivalent. That is from number 6 using certainty equivalent. We're having certainty equivalent as one of the techniques. Now, one fact is very much clear that the project with higher risk should be definitely discounted at a higher rate of return. Say project with high risk should be discounted at higher rate of return. Project with high risk should be discounted at high rate of return. And obviously this project with lower risk should be discounted at lower rate of return. Project with high risk should be discounted at higher rate of return. Project with lower risk should be discounted at a lower rate of return. Okay. One more approach to this is, let us consider only that component of cash flow which is certain, which is sure. So, for example, if I say expected or not expected, but you will say likely cash flows in next year. You say that there is a 20% chance, you're assigning the probability. There is 20% chance that you will get a cash flow of 30. There's 50% chance that you get a cash flow of 60. There's another 30% chance that you will get a cash flow of 100. Right? Now, from this, can we get the expected cash flow? Can you tell me what is the expected cash flow over here? What is expected cash flow? Yep.
$66.
66. It is like probability multiplied by cash flow plus second probability multiplied by cash flow plus third probability multiplied by cash flow. 66. The expected cash flow is 66. So we are expecting a cash flow from this project to be 66. But can you tell me, out of this expected cash flow of 66, what is very much sure to be receiving? How much are you going to receive surely?
30. Because the probability
30?
is very low and conservative.
Right? Sure cash flow, or you can say certain cash flow, sure cash flow or certain cash flow is going to be 30. If the expected cash flow is 66, sure cash flow or certain cash flow is going to be 30. Okay. Expected cash flow is 66 and sure or certain cash flow is going to be 30. So out of 66, yeah.
So how does 30 come?
Because 30 is the minimum cash flow that you're going to get, right?
Okay.
At least you're going to get this, right?
Minimum
Can be
cash
more
flow.
than that, but at least for sure you're going to get 30 because there is no possibility of zero given over here. So you can say bare minimum return, bare minimum cash flow that you're going to get is 30. Any value. So expected cash flow is 66. Sure or certain cash flow is 30. Right? So can you tell me what is the certain portion of cash flow? How much portion of this 66 is surely that you're going to get? Can I say it is 30 divided by 66, which is 0.4545. And this is exactly what we call as certainty equivalent. This is exactly what we call as certainty equivalent. Okay.
Yes.
Right. So certainty equivalent is 0.4545, which means 45.45% of the cash flows are surely going to be obtained. Right. Now, let's say this 66 and 30. This is the risky cash flow because it is subject to fluctuation. 30 is the sure cash flow because that is what you're going to get it for sure. Right. So if I want to discount my cash flow, this is subject to risk. This is going to be discounted at a risk adjusted higher rate of it. But when I'm going to look at only the sure or certain cash flow, I'm going to discount at which rate of return? Should it be at a riskier, higher rate of return, or should I discount it at some other rate? Yeah, tell me. 66 is going to be discounted at
higher rate of return. So this is expected.
risk adjusted rate of return. So expected cash flow is to be discounted at risk adjusted rate of return, whereas sure cash
Nominal
flow,
rate of
certain cash
return.
flow. Yeah.
Nominal rate of return.
No. It's not nominal rate of return. Since this is a sure, known, undoubted cash flow, this is going to be discounted at risk-free rate of return because this is what you're going to get for sure. So since there is a surety, I'm going to discount the certain cash flows at risk-free rate of return. Okay. So out of the expected cash flow, if you know what are the expected cash flows, you need to discount the expected cash flow at risk adjusted higher rate of return. Whereas in case of sure cash flows or certain cash flows, you need to discount it at a risk-free rate of return. Okay. Now let's look at question number 6 for better understanding of this. The textile manufacturing company is considering one of the two mutually exclusive proposals, Project M and N, which require cash outlays of 17 lakh and 16 lakh 50,000 respectively. The certainty equivalent approach is used in incorporating risk capital budgeting decisions. Certainty equivalent approach is used in incorporating risk in capital budgeting decisions. The current yield on treasury bonds is 6%. Expected net cash flows and their respective certainty equivalents are as follows. Expected net cash flows and their respective certainty equivalents are given over here. So here, 1, 2, 3, we have the cash flows. We have the certainty equivalents given to us. What are these certainty equivalents? These are like proportion of cash flows which are going to be surely there. Present value factors of ₹1 discounted at 6% is given. Right? I recommend which project should be accepted. Okay. So I'll do it for project M and then you can repeat it for project N accordingly. project M. Say here, expected cash flows, certainty equivalent, and then we will calculate certain cash flows, present value factor at 6%, and finally PV. So we have here 0, 1, 2, 3. Zero, 1, 2, 3 expected cash flows. So initial year, it's going to be an investment of 17 lakh. Then year 1, 2, 3, we have cash flows of 9,000, so 9 lakh, 10 lakh, 10 lakh. Certainty equivalents are given in the question 0.8, 0.7, and 0.5. Okay, so these are the certainty equivalent, which is telling us what proportion of cash flows are surely going to be there with us. So expected cash flow will remain same till this one. And then certain cash flows are simply going to be 9 lakh multiplied by 0.8. So out of 9 lakh, we are saying 80% is sure. When it's 80% is sure, means 7 lakh 20,000 is surely what you're going to get. Then the other two numbers will be also computed. Right? So these are the certain cash flows. Now these are the cash flows which are surely going to be arrived at. So now we can get the present value factor. Right? 6% PV factors are given. 0.943, 0.890, and 0.840. Okay, so we can get the PV as certain cash flow multiplied by PV factors, right? And then we take the sum of, working out to be 21,960 as the PV. That's for project M, right? Same way, can we do it for project N wise similarly? So on the similar lines, try to do it for project N. Remember, project N has got a, and project N has got a cost or initial investment of 16,50,000. So taking these numbers, just compute the NPV by taking the certainty equivalent approach. Get the certainty equivalent, use the certainty equivalent approach to get the NPV, guys.
$342 600 NPV.
Okay. It is easy. I just need to get over here. This is minus 16 lakh 3,000, 9 lakh, 9 lakh, and 10 lakh. Certainty equivalents are 0.9, 0.8, 0.7.
342 600.
Yeah, 342, 630. So of course, with regards to certainty equivalent project, N should be selected because that is going to provide you a higher level of NPV. Project N is going to provide you a higher level of NPV, and therefore that should be selected. Are we clear with this certainty equivalent, guys? Certainty equivalent approach?
Yes.
Yeah, we just convert all the cash flows, certainty equivalent, all the cash flows into, we convert them into the certain cash flow, which is a set of cash flow that you are surely going to get, and then we just take the PV using risk-free rate of return. Okay, are we good, everyone?
Yes, sir.
Yep. Yes, perfect, everyone.
Yes.
Okay, so
Yes, sir. Understood.
certainty equivalent approach is done with regards to risk. Now, recommend which project should be accepted. Of course, project N. Then, suppose if the risk-adjusted discount rate is to be used for evaluation, then which project would be appraised with a higher discount rate? Which project would be appraised at a higher discount rate? Out of project M and N, which of the two projects will be discounted at a higher rate of return? Suppose we want to, if we are
M.
not using the certainty equivalent approach, then which project will be discounted at a higher rate of return?
Project M.
Project
M.
M. Why?
So NPV is less, so it is higher risk.
Sorry, as it is?
As NPV is less than
No,
project M.
NPV, if the NPV is less, that doesn't mean higher discount rate. Acha, when do you discount the cash flows at a higher discount rate? Under what condition are you going to discount the cash flows at a higher discount rate?
Higher risk.
Higher risk. So
Higher
first
risk.
check which of these two projects are having more risk.
In this question is the CE, sir. Because 0.8, 0.7, 0.5,
Yeah.
which is lower than.
So the certainty equivalent over here are, can I say, lesser than the project N? Right? Certainty equivalents are lesser than project N. So can I say project M is having lesser amount of sure cash flows? It is subject to more of like uncertainty. Right? So since there is more uncertainty in project M because the certainty equivalent numbers are low, risk is definitely lower in case of project M, and therefore that is going to be discounted at a higher rate. We cannot calculate standard deviation over here because we have not been given the probability distribution of cash flows. There's no information about probability distribution of cash flows. So therefore, we can say there's a higher discount rate will be computed only looking at mere observation of high risk. So high risk can be actually derived from the higher amount of the cash flows. And sorry, lower degree of the certainty equivalent. Lower certainty equivalent provides us an understanding that there is a lesser degree of certainty, lesser degree of surety, which in turn leads to higher degree of cash flows. Higher risk in this project, and higher risk in the project will require a higher rate of discounting.
So can we not take CE as the probability and then
No.
arrive at
If you add all of them, that doesn't come to be one.
No, not adding this. Cash flow multiplied by 0.8 and again for another 2 years same way. The way we
that
calculate
will give you the certain cash flow. See,
that is not
just because it is decimal, don't assume that it's similar to probability. No, it has nothing to do with the probability. It is going to give you the proportion of cash flow which is sure. If you multiply, right? If you multiply the cash flow with certainty equivalent, you are going to get the amount of cash flow which is surely going to be coming, and therefore we discount this at a risk-free rate of return. Okay. And this certainty equivalent, if it is lower, it means there is lesser degree of surety in the project of cash flows. Got it?
Okay, sir.
Ah, okay. Prithviraj said, if no clear observation could be made from CA given, then how can we see? If you cannot make a clear observation from the, like from here, we can see there's a certainty equivalent is lower. Here, certainty equivalent is higher. Therefore, we can definitely say that the project M is having a higher risk than project N, and therefore that should be discounted at a higher rate. If there is no clarity, like, certainty equivalents are almost similar, or, there's no clear cut observation which we can make out, then of course the answer is we cannot decide on the basis of certainty equivalent. We need to compute the standard deviation and then decide which project is more riskier. Okay, got it, everyone? Okay, perfect.
So
So
can you please explain?
if I hope first part is clear. If the certainty equivalent is overall, you can see here the certainty equivalent is lower than in each of the year. Like in first year, this is 0.8, this is 0.9, second year it is 0.7, 0.8, 0.5, 0.7. So every time project M is having a lesser degree of certainty equivalent.
Good.
Right? So therefore we say project M is having lesser surety. Lesser surety means more uncertainty. More uncertainty means more risk. And therefore that needs to be discounted at a higher rate. But if it is a situation that in one of the years the certainty equivalent is lower here, but higher in the second year, but lower in the third year, when there is no clear-cut distinction between the certainty equivalent, then you say that project should be selected on the basis of
Standard deviation. Standard
standard
deviation.
deviation. And you'll have to compute the standard deviation and then only take a call. Because here we can surely make out that this project is having lesser degree of certainty. But when we can't make out which project is having a higher degree of certainty, we need to uh, look at calculation of standard deviation. And if the data is given in the question regarding standard deviation, we will calculate it if we have the probability numbers. If we don't have the probability numbers, then we will say that we cannot, state, or we cannot conclude which project should be discounted at a higher rate. Are we clear, everyone?
Yes, sir.
Okay, fine. So with that, let's just take a break right now, guys. Approximately 10-15 minutes break so that we back after that and we'll do one more question and some concepts to recap the remaining portion of the advanced capital budgeting. Okay, so let's just take a break, guys. See you soon. Yep. We have this one more question discuss in today's session, which is the question number 5. Again, it's going to be with the risk analysis point of view based on NPV, another risk part of it. So we have information that project X and Y are under evaluation of XY company. The estimated cash flows and their probabilities are given below. The investment year 0, we have like 70 lakhs of investment that can yield us cash flows in year 1, 2, 3 of different levels. We can see that in year 1, we are likely to get a cash flow of 30, 50 or 65 with a probability of 0.3, 0.4 and 0.3. And again, in the second year, the cash flow can be 30, 40 or 55 with the respective probability of 0.3, 0.4 and 0.3. And the third year, similar cash flows with the probabilities are given to us. And then we have project Y, initial investment of 80 lakhs and annual cash flow throughout their life. So in each of the years, first, second or third, we are likely to get a cash flow of 0.2, 0.5 and 0.8. Which project is better based on NPV criterion with a discount rate of 10%? And you have to compute the standard deviation of the present value distribution and analyze the inherent risk of the project. Okay, so let us solve it, which is question number 5. Over here, probability weights are given 0.3, 0.4, 0.3 for each of the respective years. So we have like possible scenarios. 3 scenarios are possible. First scenario with a possibility of 30%, second scenario with a possibility of 40%, third scenario with a possibility of 30%. So let's say computation of NPV. Computation of NPV. We'll say year, particulars, cash flows. Now, those cash flows are going to be different. So let's just if there's a present value factor. The present value factor is at 10%. Okay. Now, once we have the present value factors, then we will say first part with a probability of 0.3, second part with a probability of 0.4, and third part with a probability of 0.3 again. So here we have the cash flows and the PVs. Same way we have the cash flows and the CV. We're going to get the NPV for each of these respective numbers. Year 0, 1, 2, and 3. The particulars, we have initial investment. And then we have the cash flow after tax. Present value factor at 10%. This will be 1. And at 10% PV factor, we need to get it as 1 divided by 1.1. These two number of years. Cash flows are the first scenario. We're going to get a cash flow of 30. Initial investment is 70. 30, 30, 30. Second scenario possibilities are 50, 40, and 40. And third possibilities are 65, 55, and 45. Okay. Now, just get these PV numbers, guys, and give me the NPV numbers for all the three scenarios. So give me the NPV numbers for all three scenarios. Yeah, calculate it and give me the NPV, guys. Just given you a outlook and an outline is given to you, just need to work it around. Get the NPV numbers, guys. For each one of them.
37.35.
37. First probability, first NPV is 4.61. So we get the probability, NPV for the second and the third scenario also. NPV for the second scenario and also the third scenario.
For second is 8.51.
8.51. Second is 38.56, right? Take the numbers. 38.56. Second case. Then we get for the third scenario also. Third one, you can say cash flow multiplied by the PV factor. And we take a sum of. Did you get these three numbers, everyone? 4.61, 38.56, and 68.35.
Yes, sir.
Yeah. Okay. That's the first part. Now, which project is better based on only NPV criterion? They are asking us. So I need to get it for project Y also. So project Y, we have the probability weighted, and every cash flow, every annual cash flow is given to us. So this was for project X. Now, same way we'll do it for project Y.
So how many project X mean probability to consider clearing or
हाँ क्या क्या
hello?
There is a probability
Yeah.
but that we
Say
need
no.
to consider also.
So it's the
Probability part.
probability to consider
No, probability we haven't considered it. We haven't considered it because we are just calculated the NPV. We will compute again 3 NPVs for project Y, and then we will take up the further things. Okay, so we will be considering probability. Wait. So project Y again, we are going to compute the NPV. So we're going to compute the NPV. Here we have year, particulars, PV factor at the rate of 10%, cash flow, PV. Now again, we are going to have it on this similar lines. Here also we have 3 scenarios with probabilities of 0.2, 0.5 and 0.3. Okay, we have the cash flow and PV. So here 0. Now in this project, there are no different cash flows in 3 years. So I can simply say this is from year 1 to 3. In fact, and this is an investment, right? So PV factor is obviously 1. What should I write the PV factor over here? Because in first case, minus 80 would be the cash flow. And in every year, you stand a chance of getting 40 lakhs. What should the PV factor over here?
Total of 3 years, I mean.
Total of 3 years. Yes, exactly. It's going to be the annuity factor. This is going to be the annuity factor. We have a minus 80 and 40. Then second is going to be minus 80 and 45. And this is going to be minus 80. And now just try to compute the NPV over there. Get the NPV of the project in 3 different scenarios for project Y.
$19.48 for project 1.
Or project, I mean, scenario 1.
Scenario 1.
$19.48 or 19.47. Same way do it for second and third scenario. $31.91 for the second scenario, guys.
Yes, and another last scenario 44.35.
Okay. Cash flow multiplied by the factor. That's 44.34.
Yeah.
44.34 is the answer. So now we have the distribution of NPVs. We have a proper distribution of NPVs. So first up, we're going to discuss about probability, NPV. So this we are doing it for project X. We have probability and NPV numbers. Probability is 0.3, 0.4, 0.3. 0.3, 0.4, 0.3. NPV values are 4.61, 38.56, and 68.35. Right? And similarly, we have distribution for project Y also. So project Y would be like 0.2 chance with the NPV of 19.47, 0.5 chance for an NPV of 31.91, and 0.3 chance for an NPV of 44.34. Now from this, we want to get the expected NPV. Right? From this, we want to get the expected NPV and the standard deviation numbers also. Can we calculate the expected NPV and standard deviation from this? Yeah. Can we calculate that? Expected NPV.
So it's 37.31.
So expected NPV would be like probability into NPV.
37.31.
Right? And we also have to calculate the standard deviation. So expected NPV, that's computed expected NPV, 0.3 into this. These numbers are the probability into NPV. And we just add them all. 37.31 is the expected NPV, right? Correct? Yes or no? You getting it? Probability into NPV, that's your expected NPV. Now, once you got the expected NPV, I want you to calculate the standard deviation. Now, standard deviation will be computed as NPV minus expected NPV. NPV minus expected NPV. Then probability multiplied by NPV minus expected NPV square. We are going to do this square. Probability into NPV minus expected NPV square. And then compute the standard deviation. So just try to compute the standard deviation over here, variance and the standard deviation. Huh? Yeah. We'll take NPV.
Variance is 38. No, variance is 38.42. And standard deviation is 6.29.
Going to be probability multiplied by this square, right? Then we take a sum of all of probability into NPV minus expected NPV square. So this works out to be 610.63. We can get the variance. Variance is 610.63. What will be the standard deviation? It will be square root of 610.63. Okay. We get the standard deviation numbers. 24.71, everyone. Yep. Okay, same way we have to do the calculation for project Y. Now for project Y, similar calculation, but the probabilities are going to be different. So it's going to be 0.2, 0.5, and 0.3. NPVs are 19.47, 31.91, and 44.34. Okay, just go ahead and calculate the expected NPV variance and the standard deviation. Expected NPV variance and the standard deviation. The expected NPV variance and standard deviation, guys, for this project Y.
$33.15.
How much?
33.15.
0.15. I heard something 0.15. Nothing else. Probability into NPV. Just add it up. 33.15, that's your expected NPV. Okay, perfect. Get the variance and the standard deviation also, guys. What's the variance number? Variance and standard deviation. Yeah. Expected NPV 33.15, then we need to take the deviations. Deviations will be NPV minus the expected NPV. Then NPV minus expected NPV square multiplied by probability. Take a sum of it, right?
75.2.
Sum of this 75.76. Right? Yeah. Into probability. Square with probability.
Standard deviation.
Okay, so
8.76.
variance is 75.76. Right? And what about standard deviation?
8.70.
Square root of 75.76. 8.70. Compute standard deviation and analyze inherent risk of the projects. Okay. Did you get these standard deviation numbers? Did you get these standard deviation numbers, guys? 8.70. So what we can observe is the second project Y is having a relatively lower standard deviation or a lower risk, 8.70, with the expected NPV of 33.15 as compared to 37.31. Okay, the expected NPV 33.15 as compared to 37.31. So you can say project Y is having lesser amount of risk, and also the expected NPV is lower. Lesser risk and lesser NPV. right? That's the inherent risk that we have. Okay, so that completes this particular question. Question number 5. So I think we are done with all the questions that we have in our assignment, but there are a few concepts which are left out to be discussed. So I'll be discussing those concepts from the original data file, but we'll be doing it the concepts and certain numbers maybe. So just wait. Just save this. Save this and I'll open the original file which we are going to discuss the remaining concepts. One of the other concepts that we had is something called as an adjusted present value. So let's just quickly try to recap it with the help of the same example what we have done in the regular lectures. So Modigliani-Miller model we have learned in CA Inter, which is again an extension of, the adjusted NPV is extension for the same. The Modigliani-Miller model, wherein we stated that value of levered form is equal to value of unlevered plus debt into tax rate. Value of levered form is going to be equal to value of unlevered form plus the amount of debt into tax rate. So this is what we are basically looking at. So your debt into tax rate was essentially the tax saving due to debt in a levered entity, right? So present value of all the future tax savings is what we used to take. Present value of all the future tax savings was interest into T upon cost of debt or KD. Present value of tax savings due to debt is interest into tax, right? So interest into tax, that's what your present value of future tax savings are there. So due to debt, and then you simply divide it by the cost of debt to discount it into the present value level. Now, additional value which a levered form had, it was the value of debt into tax rate, which was representing simply the present value of all the future tax savings. Now, when we come to adjusted present value or adjusted NPV, it's also going to be on the similar lines. So adjusted NPV is essentially a base case NPV or base case present value plus present value of tax savings on interest if the project is being funded by way of debt. So when you're going to, project is going to be funded by way of debt, you need to add over it. What is levered? Levered means the firm which has taken a debt. Rakesh, levered firm means a firm which has taken debt, and unlevered means a firm which does not have a debt. It's like we are funding our project by way of debt or by own funds. So if you're like fully funding our project by way of own funds, we are going to fully fund our project by own funds, then it's going to be, if you're going to fund our project fully by way of owned funds, it means we are going to have it essentially by way of no debt. And other way is right, having some amount of debt and having some amount of owned funds as a funding. Right. So base case PV is basically PV which is calculated assuming project is going to be funded by way of equity. PV which is calculated assuming project is funded by equity. Base case PV is PV is calculated assuming that the project is fully funded by way of equity. And now we are evaluating what will be the impact on the NPV if we are going to fund the project partly by way of debt. So there we say that normal NPV, whatever is there, that's definitely going to be there. Plus, we are also going to have tax savings on interest. Plus, you're also going to have tax savings on the interest. So let's try to understand with the help of an example. Suppose initial cost is 10 lakh, tax rate is 30%, cost of equity is 20%, cost of debt is 15%. And cash flow after tax that we are likely to get is suppose 3 lakh till perpetuity. So this is a project wherein it's not going to end at any nearest point of time, rather it's going to continue till perpetuity. So we'll compute the base case NPV. The base case NPV is simply present value of inflows minus present value of outflows. The base case NPV is simply going to be present value of inflows minus present value of outflows. So present value of inflows would be like, so 3 lakh is the CFAT that we are going to get every year. 3 lakh is the CFAT that we are going to get every year. And that needs to be discounted till perpetuity. 3 lakh divided by cost of equity, because we are assuming that we are going to fund this project fully by way of equity. So if you are going to fund this project fully by way of equity, okay. So if you're going to fund this project fully by way of equity, then this is going to be simply like, if the project is going to be funded totally by way of equity, then it will have present value of inflows minus present value of outflows to be 3 lakh upon 20% minus 10 lakh, because when you're doing 3 lakh upon 20%, that is giving you the present value of cash inflow. Okay, that's going to give you present value of cash inflows. 3 lakh upon 20% minus 10 lakh, that's going to be the 5 lakh figure, right? So currently, without any debt, we can say present value of inflow is 3 lakh upon 20%, which is 15 lakh, minus initial investment of 10 lakh, which is 5 lakh. Now, if we are evaluating of bringing debt into the picture, if we are evaluating to bring debt into the picture, we would like to say what is going to happen in the form of tax savings. So we'll first say what is the interest expense per annum. Suppose if you are going to fund this entire project by way of debt, if you are going to fund this entire project by way of debt, then we'll say that on this 10 lakh, we'll be paying 15% interest, which is 1,50,000. On that 1,50,000, we will be saving taxes, because interest being a tax deductible expenditure, we will be saving 45,000. The present value of future tax savings would be simply this 45,000 divided by 15%, that is 3 lakh. Right? So now if entire investment is by way of debt, we can say that we are going to have a tax saving of 3 lakh. So will there be an increase in NPV due to this tax saving? Of course, yes, because we are going to save on interest. We are going to save on the taxes. So now the adjusted NPV will be 5 lakh plus this 3 lakh, which is amounting to adjusted NPV to be 8 lakhs. Okay. So with this information, we are quite clear what we mean by the adjusted NPV. So adjusted, in case of adjusted NPV, we take the base case NPV and then add the present value of future tax savings. Would you like to solve one more question on this? I'll give you an example to solve to get the adjusted NPV. Yeah, similar question. Would you like to solve it? I will give you a bit of variation. So let us say similar data, but a bit of variation. So initial cost is, let's say, 6 lakh. Cost of equity is 15%. Cost of debt is 10%. CFAT is going to be, let's say, 2 lakh till perpetuity. Tax rate is 30%. I'll say calculate adjusted NPV if 60% of project will be funded by debt. Yeah. So try to calculate the NPV, guys. Try to get the NPV. Adjusted NPV first. First get the base case NPV and then the adjusted NPV.
7,33,333 with only equity.
Okay. Yeah. What's the base case NPV, guys? The base case NPV is computed as cost of this 2 lakhs divided by cost of debt, which is 10%, sorry, cost of equity, which is 15%, minus 6 lakh. So 2 lakh divided by 15% minus 6 lakh. 6 lakh. Yeah. So 7,33,333. To that, we are going to add tax savings on interest. Now, tax savings on interest will be of the project cost 6 lakh, 60% is going to be funded by debt. On this, you will be paying 10% interest, on which you are going to save 30%. Right? So we can say it is simply going to be, I mean, over here, as we did, simply present value of future tax savings. So 6 lakh into 60% on into 10% on that, 30% will be the tax savings on interest. So you can say tax savings on interest will be 6 lakh into 60% into 10% into okay, apologies, sir, because there's some power cut over here, so I just got logged out. Okay. So tax savings on interest is 10,800. And then I simply take present value of all future tax savings. The present value of all future tax savings will be 10,800, right? 10,800 divided by the cost of debt, which is 10%. So 10,800 divided by 10%. And then we say adjusted NPV will be this plus this one. So 8,41,333. Are we getting these adjusted NPVs? Yep.
Yes.
Yep. Okay, perfect. So we got this adjusted NPV as 8,41,333. That was one concept, adjusted NPV. Then we had also questions based on replacement decisions, right? So replacement decisions was again looking into deciding whether to replace an old equipment with a new or not. So first, that for that we need to compute the incremental cash flow per annum from the new system, which we calculated simply by taking the incremental sales, that is additional sales, additional savings, and then from that you're going to subtract the additional expenses that you have. Plus, you're going to add the tax savings that's going to be happening on the incremental depreciation. So incremental sales plus incremental savings, less incremental expenses plus tax savings on the incremental depreciation is going to be looked at. And then the incremental sales will be computed. Incremental savings will be computed, expenditure will be computed. You'll make this as a after-tax cash flows before the depreciation impact. Then you need to give the depreciation impact, which will be incremental depreciation again. So you'll get the net incremental cash flow from this. Then finally, you will talk of what will be the cash outflow for acquiring the new system. So when you want to go for cash outflow, you need to look at what is the cost of new system, less any salvage value of the old system, less any further tax savings from the loss on sale of old system. And then net cash flow, like you just need to look at what's the net cash flow, and then simply you take the NPV. It's just like a normal NPV question with a bit of different approach of timing of cash flows. Then we had decision tree analysis also in one of the concepts. The decision tree was like whenever you want to make a decision, it's going to be represented by a square. Whenever it's an outcome, it's going to be represented by a circle. So whether, again, we used to draw the decision trees, and each of these decision trees, where we need to have the different branches. Each of these different branches, we used to compute the combined probability. So combined probabilities was calculated by multiplying all of them and then looking at cash flow that is happening at each of the levels. Okay, so deciding whether to invest or not, we had typical questions from those areas also. And yeah, we have done certainty equivalent, we have done sensitivity analysis is also done. Okay, so we have covered like almost all the concepts that we have in this advanced capital budgeting. Now, I put it across to you. If you have any queries in this topic, you can ask me.
Sir, Brakesh.
Yeah, Brakesh.
It is regarding that nominal and real, which I asked earlier. Now, can I ask?
The query? I didn't get.
Yeah,
you
Sir,
can.
In question, all figures have been given in a real terms, real figure.
Okay.
And discounted rate have been given both real and inflation. So, I mean, what should we presume and calculate the answer?
If the real cash flows are given, you can discount them directly using the real rate of return.
Okay. So the discount rate for inflation is given just to confuse?
You can take it or
but Jagundri, let me reply this query. I think Abrakesh sir is want to ask if nothing has been mentioned whether the given cash flow is real or nominal, then what should we assume? You want to ask, sir, that?
Yes, sir.
So, sir, in that case, if there is a scope of any confusion, so we consider answer both way. Don't worry.
Okay, sir.
Unless and until there should be any, if there is any hint in the question, because you have to go through the question very carefully. If there is any hint which indicates whether it is a nominal or it is a real, then we have to follow that approach only. Otherwise,
Okay.
if there is a confusion, you can answer anyway. We will consider both answers correct. There is
Okay.
no passport.
Okay, thank you.
Okay.
Okay, student. If you want to ask any question, you are free to ask.
Can you share this Excel file also having multiple sheet?
Let me share, Bandhuji. Sir, beta, we can share, but issue is that since you in the examination, you have to do this practice all with your own hands. But see, you have to answer the question with on your own hands. So of course we will display the solution. Don't worry. That's not an issue. But in giving it in Excel may be quite difficult for us because we normally encourage the student to practice with their own hands. So otherwise, what will happen? You will start practice. Maybe. Okay. Of course, we will put the solution somewhere other around. Don't worry about the same. Okay. So.
And the theoretical parts that sir has written on the sheet 19, 18, like I want the formula.
Which
sir has mentioned theoretical part, like in sheet 18, 19, formula part is there. So
this
it
one,
would be great.
This would be there, I think. This you can get it from the previous regular lectures also. This is the same file which I've used there.
Okay.
Better see, normally see what happens. Sir has done the Excel calculation in Excel to fast up the calculation because capital budgeting chapter is that chapter which involves a very huge calculation. Okay. So, and it saves the time. But otherwise, please try it with your own hands. Okay. Only then you will came to know what are the mistakes you can commit in the examination.
Yes, sir.
Okay, student. I think we have no more queries. Here, I would like to mention one or two things. First of all, so student, it is very important that you fill up the feedback form. Okay. And my request to you, even all the students who are listening, please fill up the entire this form because see what happens. Once you give your feedback, whatever be the feedback, even not for this class, even for every class, okay, you are attending, please give its feedback because feedback is a valuable suggestion for us. Okay, once you give the valuable suggestion for us, then we further improve our classes. So my request to you, please don't hesitate to give the feedback. Your free feedback is very valuable for us. Okay, free and fair. And next very important point is in the next class, okay, we will take up the topic of security analysis. Please note that there is no recorded lecture of any security for this security analysis because this is primarily theoretical. You can say that dominated chapter, but of course some numerical questions are there. So in the next class will be completely theoretical. This is a security analysis class, and I will distribute the assignment. I think by tomorrow or by day after tomorrow, I will circulate the assignment. And in today's class, there is one topic has been covered that by Jagbantu sir. That is adjusted present value. Student, please note that this topic is very important because this topic will also be covered up in the topic of international financial management, where the adjusted value concept will also be applied there. Okay, of course, there is little bit difference there because, but criteria is the same. That is unlevered that you compute NPV, then you take the benefit of the debt portion. So, Jagbanduji, just share our email ID and phone number.
Sir, I have a question. One query, sir. Ashish, sir.
Please.
Sir, while I'll try to give the feedback by pressing the feedback form, then they will ask the date and session. Once I fill up both the criteria, then it will give an error message that no data found.
Okay, let me just, today I will just get it confirmed. Okay, thank you for your feedback, sir. This is the feedback that's I wanted. Okay, I will confirm back to you, sir.
Sure, sir. Thank you.
Okay, because if there is, I connect to my technical team. Okay, So then I get it corrected just now.
Sir, Ashish sir, the exact error message is sorry. Please select proper lecture date and session.
Okay. Then it is coming.
No, sir, same query.
The
Same, no problem.
it's coming and stopping. Then it's not allowing us to go further.
Just give me 1 second, sir.
Sir, you can test yourself also.
Okay. But just a second. Just a second, sir. Let me check this. One second, I am also filling up the form. Okay, I go on a lecture date. This is today's date. Okay, this is I select the session, morning session. Okay, then I go there and then sorry, please select proper lecture date. Okay, thank you. Thanks a lot. Okay, I just get it. Just sort out this issue today itself. Okay, thanks a lot. Okay, student, thank you for your feedback, and see you in the next class. Jagbanduji, just stop sharing this. I think student, you must have noted my email ID as well as my telephone number. If you have any query after the class, you can discuss with me. Of course, today is our holiday. Okay, you can connect me on the Monday, or meanwhile you can send the email at your email this email ID. Okay, student, thank you. Have a nice day and revise whatever I will discuss in today's class. Okay.
Sir, one last thing from my side.
Please.
Actually, I want that formula part to be written in my formula in a notebook, so that will be easy as a LDR, last day revision in exam. Like sir has mentioned, the adjusted NPV part.
No, exactly what you want, better.
Actually, sir has mentioned that adjusted NPV formula, like in that particular Excel sheet, which having like formula type, it was written in theoretical part. Like this would be a. Can you just move to the sheet number 17, 18, 19?
Okay, just
I want a formula part, which has
this you want to say
18. Like this one also, like decision tree analysis part, and the next sheet 19, 20.
19, just show it to the student. Just display.
Yes, please click on sheet 19. Yes, on the top. Yeah. Yes, just that, like sir has mentioned, this part, increment cash flow per annum from new system is increment sales plus increment saving minus. So that I want this part to write in my notebook.
Okay, you want to write this? Okay.
For LDR, last day revision in exam.
You can take a screenshot right now.
No problem.
So is it not possible to share on the upload part?
Okay, we will see if it is possible. Okay, Jagbanduji, I think we need to share this Excel sheet.
Okay.
Yes, please. Thank you.
Okay.
Thank you, Ashish sir. Thank you, Jagannath sir.
Okay, so student, thank you. Jagmohan ji, after class, just contact me. Okay.
Okay.
Okay. Okay, Ashok ji, the session is over.
Okay. Let's stop here.
Thank you. Have a nice day. Okay.
Okay.